My name is Edward Robinson, a legal director in the corporate team at Charles Russell Speechlys.
Hello, I am Mary Perham and I'm a senior associate in our UK private client team.
As part of our new FIC Files series on family investment companies, commonly known as FICs, today we look at how FICs are funded by cash with practical options for private clients. From a corporate and accounting perspective, it is necessary for any assets or cash contributed into the FIC structure to be properly categorised so that there can be a corresponding accounting ledger entry for the company. What we do not see is people gifting cash or assets into their FIC, as this is very tax ineffective, so the contribution will need to be recognised in another way. Typically, we see contributions being made in one of three ways. Firstly, the contribution can be made in exchange for shares being allotted by the company, and this can include a share premium amount on top of the face value for such shares. Any value contributed in this way belongs to the FIC absolutely. Secondly, we have a loan structure, where the FIC records a liability owing to the contributing party equal to the value transferred. Tax advice needs to be taken about the terms of the loan and whether this is interest-bearing or not. The receivable of the loan remains part of the estate of the contributing party, so would fall within any inheritance tax calculation unless it is transferred out during the lifetime of the holder. Repaying a loan can be a tax-effective route of extracting money from the FIC. Finally, you can have a quasi-equity option, such as redeemable preference shares. These are shares of the company, but unlike ordinary shares, can, if there are profits, be redeemed by the company to return money to the shareholder and cancel the shares. Due to the flexibility of funding options, we can tailor the contributions to the specific requirements of each family, depending on their individual circumstances and tax position.
Turning to the inheritance tax position relevant to these funding options. As Edward says, it is tax inefficient to gift cash to a company, and for IHT purposes, it is an immediately chargeable transfer, so subject to 20%. So it's crucial that this is avoided. Whether the funding is by loan or share subscription, the value of the shares or the benefit of the loan will form part of the founder's estate for IHT purposes until such time that it's gifted, for example, to the next generation. This gift would be a potentially exempt transfer and therefore under current rules would pass free of IHT if the founder survived 7 years. The ultimate shareholders could also subscribe for shares directly, but with the founder paying the subscription price, that payment for the shares is again a potentially exempt transfer. Importantly, the founder must not derive any benefit from the assets given away for the gift to be effective for inheritance tax purposes. Even if the founder retains a loan benefit, the structure permits capital growth in the value of the FIC to be outside the founder's estate for inheritance tax purposes. This growth is then held for future generations, but the founder can retain control in ways that we will come on to discuss later in the series. For some, this is an appealing way of transferring wealth to the next generation.
Every FIC is unique, and there is a great deal of flexibility in how they are set up. The key is tailoring the structure to each family's needs and their immediate and long-term goals. Thanks for watching, and look out for future episodes in our FIC Files series.